Remember where we are coming from. We said we're looking at intra-company transactions, and I said they can either be balance sheet items or trading items. Where most of you struggle is the trading items, and I urge you to pay a very good attention. Usually, when you have trading items, there are two areas they try to test you. Is either they are trading, which means they are selling inventory, or they are selling a non-current asset, which is like PPE. Usually, these are the two popular areas. Yeah. And the most important thing to note here is unrealized profit is your major challenge. Unrealized profit. Because remember, we said all intra-company transaction must be eliminated. This is an example of intra-company transaction. And what is usually eliminated is the unrealized profit. That is the popular item that must be eliminated. The question is how? How do you calculate your unrealized profit? In questions that involve inventory, your understanding of margin and markup is very critical. And I'm going to do a quick refresh on this now. But before I go into that, let me give you the easiest one, which is unrealized profit for non-current assets. This is very easy. This is usually equals to, you need to calculate the carrying value, at reporting dates after sale. Remember, either parent is selling to the subsidiary or subsidiary is selling to the parent. When you calculate this carrying value, then you deduct it minus carrying value. So you need to also calculate the carrying value. So you need to calculate two carrying values. Carrying value still also at reporting date. However, with the condition of if sale did not happen. So which means if that transaction did not happen, what would have been the carrying value? And as it has happened, what is the carrying value? The difference between these two is equal to your unrealized profit anytime you have an item of non-current asset. Don't worry yourself on any form of computation. Don't just stress. Remember, like I said, we are focusing on statement of financial position. So don't get it confused. When we get to consolidated income statement, I will open up some other parts of discussion, but just follow it step by step. Put your mind in statement of financial position for now. So that is how to calculate unrealized profit for non-current asset. However, for inventory, it is not like that. Usually you have to either use your margin knowledge or your markup knowledge. So let me quickly give you a flashback on markup and margin, because I know it's a concept that students struggle a lot. So know that whether you are talking of margin or markup, they are just two different ways of calculating profit. There are just two different ways of calculating profit. I will represent profit as that lambda sign so that I don't have to write profit in full. So if you are looking at margin is saying that profit, if the information you have in the question is margin, just know that your profit is equals to margin multiplied by selling price. And if the information you have in the question is markup, then your profit will be equals to markup, which will be given also in percentage, multiplied by cost of sale. And I know I don't have to tell you that profit is equals to selling price minus cost of sale. So you don't need to memorize anything. Once you know this equation 1 and you know equation 2, and obviously you already know equation 3, any question they give you, you will be able to calculate your unrealized profit. It is not difficult at all. Once you know this, then you can calculate unrealized profit. And what is the rule? Just eliminate it the same way we've been eliminating, which means reverse all outstanding transactions that are intra-company. And let's just play with something quickly. Let's play with something so you can appreciate it better. Let's look at this example. Yeah, let's say step 1, a parent bought inventory. Yeah, this time around from third party. So this is not intra-company transaction. The parent bought from third party at $10. Remember I said, please, let's be using entries. What will be the entries? It means that the parent would have debited his inventory with $10 and credited his cash with $10. Now let's say something happens next. This parent sold the inventory to its subsidiary, however, at $12. So now parent is selling to subsidiary. So this is now intra-company transaction, which means two things will happen. The first thing will happen in the parent's book. The second one will happen in the subsidiary book. So parent and subsidiary will post these entries. Parent has sold goods at $12. So which means you will recognize revenue. So credit revenue, $12 is sold for $12, and debit account receivable with $12. Likewise, you need to recognize cost of sale and remove the inventory because he has sold it. So debit cost of sale with $10 because that's the cost to him. And it's going to remove it from the inventory. $10. That's the parent. And the subsidiary will say, I've bought inventory at $12, so I'll debit my inventory $12 and credit account payable $12. So this is what they have both done. So what you are saying here is you guys are jokers because you are trading amongst yourself. And the rule is that we need to eliminate because you are still carrying all of this in your books at the year end. To eliminate, what do we have to do? We just need to book reverse all this transaction. So we need to reverse all of this that has happened. And how do we reverse it? We just book opposite entries. So now we need to book opposite entries in each book. So remember, instead of crediting revenue, now we'll be debiting revenue. For $12, we now credit account receivable with $12 back. We debit, so we're going to credit because it's going to be opposite. So we'll credit cost of sales with $10 and we're going to debit inventory with $10. And subsidiary will have to do the opposite as well, which means it's going to credit inventory. So to recognize that inventory, $12 and debiting account payable at $12. This is the reversal. But I understand that obviously in an exam question, you won't have to start doing all these detailed postings. Remember, I'm going into these details so that you can understand, because once you understand, don't worry, I'll give you the rule, the simple rule. But it's important you understand like this, because when we get into consolidated income statement, if you don't have full understanding how it's impacting different parts of the financial statement, you might struggle to understand how we are eliminating as well, right? So, but seeing it like this, I know I've shown you all the accounts and it's looking at so many entries to reverse. However, you don't need to put it every single detail like this. This is just to help you understand why the rule is the way it is, right? So what we need to think about is because we are only preparing statement of financial position, the group account, yeah. So we want to look at the net impact on SFP account. Talking of statement of financial position accounts. So that is what we want to look. So this adjustment, because this is the adjustment that we are meant to post. This is the adjustment. This is consolidation adjustment. So this adjustment that we are talking about, what is the net impact on SFP account? First of all, let's identify our SFP account. So we know that this is SFP account, this is SFP account, this is SFP account, this is SFP account. This guy and these guys, they are not SFP account. They are P&L account. So which means they will not only affect P&L, but they will also affect SFP. However, our retained earnings is the SFP account they will both affect. So let's list the accounts that are affected now. The first one is inventory. And what is the net impact of our adjustment on inventory? We have credit of $12 here and debit of $10 here. That is net of credit of $2. Number 2, let's look at ARAP. ARAP, we don't even need to bother because it will always cancel each other out. And the question will always tell you the amount. So I'm not even going to bring down. You can see it. Credit AR is 12. Debit AP is 12. Credit is 12. Debit is 12. That is out. So you don't need to bother yourself about that. That's already going to negate themselves out. And if the transaction was even done in dollars, cash, you won't even see that, right? Now, the only thing left, so we've dealt with this, we've dealt with this, we've dealt with this. We're only left with this debit and credit here. And both of them will impact on one account called retained earnings. What is impact on retained earnings? Debit of 12 into retained earnings and credit of 10 into retained earnings. That is net impact of what? That is net impact of debit of 2. And I'm sure you already know what this 2 is all about. Remember, it's always going to be the same figure. And this 2 is what you call your unrealized profit. Because it is a profit that the parent made when he sold. He bought the goods for 10, he sold for 12. He made a profit of 2, and the subsidiary is still carrying that inventory at the year end. In that case, unrealized profit is 2. And what do we do when we have unrealized profit? Now it's time to memorize the rule. So the rule on unrealized profit, rule 1. Now, I'm telling you first thing to memorize. Remember, I don't like people memorizing, but I'm telling you, memorize this one when you are preparing your statement of financial position. Once you calculate your unrealized profit, the rule is that you debit your retained earnings. So, debit retained earnings of the seller. Remember, it's the seller that is making the profit. And if it's a loss, it's going to be a credit. So you should understand that. That's going to be opposite if it's a loss. So debit retained earnings of the seller. The seller is one making the profit. Yeah. With unrealized profit, which is what you call the provision for unrealized profit. Then the 2 is to credit the inventory of the buyer with the unrealized profit. And that is what we have shown here. And that's what we have translated to that rule. So in your textbooks, you probably just see the rule. But I just needed to show you how they came about the rule. So you start following through with your knowledge of debit and credit, right? So remember I said it's either inventory or non-current asset. Now, if it's non-current asset, is it going to be different? It's not different. So whether it's inventory or it is PPE, which is non-current asset, the rule is the same. Please take note. It's always to reduce your retained earnings with a profit and also reduce the inventory. Remember, credit to inventory is reducing inventory, and debit to retained earnings is reducing the retained earnings. And that is the rule on eliminating unrealized profit. But I'm not going to stop there. I'm going to just work a question on how to calculate unrealized profit. Remember, these are just build up until we'll now go into a full-fledged questions. But before we do that, let's warm up again with a question on unrealized profit this time around. Yeah, let's do this one. So during the year, Sam, an 80% subsidiary, sold goods to PUP, its parent, for 1.8 million. Sam adds 20% markup on cost to all its sales. Goods with price of 450,000 were included in PUP's inventory at year end. Calculate unrealized profit. So the information we have here is markup. Remember, we're looking for profit, but information we have is markup. And I told you something. I said, depending on what you have, if it is markup that you have, you need to remember the way we do it. So if it is markup, if you have been given information on markup, remember that your unrealized profit will be equals to that markup multiplied by cost of sale. But I can see here we have only been given selling price, which is this 450,000. We don't have cost of sales. And for markup information, what we need is cost of sale. Does it make it too difficult for us to do? I don't think so. What do we need to do? With no markup, so the profit we are looking for is equals to 20%, because they gave us markup of 20% multiplied by cost of sale. And we've been given selling price to be equals to 450,000. And remember, I also told you, and you know, that profit can also be calculated as selling price minus cost of sale. So which means we know the selling price here. What we are looking for is cost of sale. And we also know that profit is 20% of cost of sale here. So if we put in this profit to be this, so which means 20% of, say, X, which is cost of sale that I'm looking for, so that I can use it here, yeah, is equals to selling price of 450 minus X that I'm looking for, which is cost of sale. Remember, cost of sale is X. So that's 20% of X is just 0.2X. So I bring that X over this one to this place. So it becomes plus X equals to 450. Okay. Remember, X is my cost of sale. So that means 1.2X equals to 450K. And I can calculate my X to be 450K divided by 1.2. And let's check it out. So 450,000 divided by 1.2. And that gives us 375. Okay. So if that's cost of sale, and I know my selling price, then I can get my profit. So that means my profit unrealized is selling price, which is 450,000 minus 375,000. And my profit will be equals to 75,000. So unrealized profit is 75,000. And in this case, to adjust for this, I need to reduce my retained earnings of who is selling? Sam, by 75K, and reduce the inventory in the buyer's PUP by the same amount, 75K, in my adjustment. And that is it. So sometimes it might be a margin. Margin is usually more straightforward. Yeah. But if it's markup, don't get rattled. Just break it down. Simple mathematics steps. First of all, know that your markup times cost of sale is your profit. And if it is margin, it's margin times selling price. That is your profit. And you know that your profit is also selling price minus cost of sale. Once you know all of that, you'll be able to calculate your unrealized profit and adjust accordingly. Gradually, we're building it. Remember, the full house we want to build, we are building foundation now. So by the time we go into full-fledged questions, you don't get rattled. Let's look for another example that is on PPE. I know I've done an example on trading now, and I've told you for PPE, how do you calculate unrealized profit? I said you need to calculate to current value. Current value now, at reporting date after sale, and current value without sale. That's all you need to calculate. So look at this question. Parent bought PPE for $100,000 on 1st of January 2005. Policy is 10 years straight line depreciation. Then on 1st of January 2007, parent sells to subsidiary for $98,000. And subsidiaries depreciate the asset over remaining 8 years, still on straight line basis. Then we should calculate the unrealized profit. This is another very easy one that you can quickly deal with. But remember, what I ask you to do is to always calculate the current value after the reporting date and the current value without the sale at that same reporting date. The difference is your unrealized profit. So don't mix it up, don't get rattled and start wondering how do you calculate unrealized profit for PPE. It is not any different from what I've told you. It's the same method and it will not change. Now let's work that out quickly. So after sale, let's do that first. After sale, the cost is $98,000. The depreciation is 98,000 over 8 years. So that's 98 divided by 12. Divided by 8. 8 years. So that's depreciation of 1 year, 12.25. And the net book value, which is the current value, will now be equals to 85.75. So that is the current value after sale. But we need to get what the current value today would have been if we did not sell at all, if parent did not buy it from his subsidiary. If the parent did not sell to his subsidiary. Parent bought this at 100K, which means 100K, 10-year depreciations divided by 10 means annual depreciation will be 10K. And from 2005, 2006 depreciation and 2007 depreciation, that is 3 years depreciation that must be charged. And so that means the cost is 100. The accumulated depreciation will have been 30,000. And that means the current value, which is net book value, should have been 70,000. In that case, our unrealized profit will be equals to 85.75 minus 70,000. And that will give us 15,750. That is unrealized profit, and that is what we need to remove from retained earnings and also remove from non-current assets, PPE. 15,750, 15,750. And that is it for intra-company transactions.